morning, everyone. I'm glad you're here today. You're catching me from the Grand Cayman Islands, and that's no fish story either. There you go. Anyway, we're going to kick off the assumption class, and I know no one would believe me that I caught that fish, so I had to take a picture of it. Mr. Porter, I know you wouldn't. I can see it in your eyes. So anyway, we're going to get going here. Let's get this class rolling along. I'm going to start with a little economic data. And the reason I'm going to do this is I want to talk about why assumptions are going to be important. And we're going to start off, the market, as all of you know, and I want to start off with a historic perspective. The market came from something that was just insane. I used to have long hair before this market, and it was all burnt off. It was just insane, the market we were in. We've never seen anything like it. And what we're doing is we're going to go back to a normal market right now. But what that's going to do, we've had an increase in interest rates, which did precipitate somewhat of a slowdown in there, going back to normalcy. I will tell you, I'm not seeing escalation clauses anymore. I'm not seeing appraisal gap guarantees anymore. That doesn't mean that's bad. That means we're coming from a market that was just absolutely insane. And I want to show you a couple of interesting things to look at. And I'm going to start right here, the number one thing. And I want to make sure. So if you look at this, back in December, we were 3.1%. Okay. I checked yesterday, we were at 5.5, something like that. We're bouncing down to 5, maybe back up to 5.5. But I want to show you this. This is hugely important to understand why assumptions are going to be important. At 3.1%, keeping our payment at $1,708, I could buy a $500,000 home, right? When rates went to 5.5%, keeping my payment the same, so keeping this payment here the same, my purchasing power went down 123, almost $124,000. That took that $500,000 house that I could buy and maxed me out at 376. So as rates went up, what it effectively did was knock people out of the market. We had been in an unsustaining low interest rate environment. It was a policy-driven bond market type of time that we just hadn't seen. We've never seen interest rates. And I'm going to just show you the interest rates here in just a minute. But the whole thing that I want everyone to truly understand why assumptions are going to be critical is really this right here. There you go. So if you have a 3% interest rate loan that's out in the market right now, that interest rate by itself is a commodity. And what I mean by that, that creates value in that type of loan because you can't get 3% interest rates right now. So what it does, it has people who now cannot qualify for that $500,000 home because the rates are 5%. You just open up a market to them that's still 3%. So assumptions aren't going to be for everybody, but there's going to be a massive need for them. And understand, if you're working with a seller, it actually adds a huge amount of value in this market because it brings people into the market that wouldn't be able to buy otherwise. Okay. And there, I circled this right here. This is it. Now, on the buyer side of that, if you're representing a buyer in today's market, they go get qualified at 5%, and they're looking again at 5.5%. That's the home they can afford right there. If they can go assume a 3% loan, they can buy that home. So the main thing I want everyone to truly understand is with the interest rate environment that we had, and I've said this for years, when you see rates go 1.5 to 2 points above where they've been for an extended period of time, that's when we were going to see assumptions. We have already started seeing assumptions, and as rates, I anticipate rates moderating up and down, but they're probably going to stay in this range that we're at right now. So you have a lot of 3% VA loans out there. We saw some that were down at 2.5 or lower even during that time frame. So the lower that interest rate is, the more valuable that home is to a buyer out in the market that can't afford because we've got interest rates that have gone up. So I wanted to talk about this before we even talked about assumptions, to understand like how come they're important and how come they're an advantage to both buyers and sellers in our current market. I'm going to shift right now, and I want to show you something another thing that's happening. The listings definitely have jumped up in our market. Okay, so the number of homes that's available for sale has definitely jumped. And I'm going to go right here. All right. Here's an amazing thing, and I want to let you know we should still have about 3,500 active listings if you look at historically. So that number really should be right in here, okay, around that 3,500 mark. That's really kind of where we should be. We're at about 2,500. So historically, we are still low compared to what a norm would be. But I want to show you something. If we just go back 3 months, okay, we were at this level right there was about 1,000 listings. So in 3 months, we jumped 1,500 listings. In other words, 2.5 times the amount of listings that was out there. It jumped that in 3 months. If you go back 5 months, we were at 500. So that almost went 5 times what we were, 5 months ago. So the reason I want to tell you that is you're having more and more homes come onto the market. We're still not saturated. So please don't even say, oh my God, Bill said that we're not saturated. We're still low by historic standards. But with the more homes that are on the market, if you have an assumable loan that the interest rate is very good, it makes you more competitive in that market against those other homes. Because interest rates are something we can't control. We don't know if they're going to go up or down, but we know where those assumables are at. Okay. And so we'll go into details on those, but I really wanted to just clarify with everyone why it's important to understand that it can really be a tool for both buyers and sellers. Okay. I'm going to go down and look at interest rates right now. So you guys have a perspective on that. So this is the 30-year interest rates. And in looking at this, you can see where we're at right now. When I did this several weeks ago, 5.41%, in any day we're checking, it's probably between 5 and 5.5 is where you're at. Interestingly enough, when we run this chart back over here, the last time we had interest rates where we're at right now was about 2009. Okay. And an interesting fact was back then home prices were about 200 to 220,000. Okay. So, we have these interest rates at 220,000. Incomes have gone up, but they have not gone up in pace with what home prices have done. We'll continue to see some adjustments in there, and we are on home prices. They're easing off for sure. But again, I want you to understand when you're comparing interest rates as they go up, we're going back on this back to 2009. So this whole time frame right in here, those loans that were done during that time frame, again, on VA and FHA loans is a commodity. It makes your house more valuable in today's current market. Okay. So I'm going to clear that here for a second. We've already talked about the purchasing power side of it, right? I want to show one more thing before I move on. When I look over the last 5 years, over 50% of the loans have been conventional. And the reason that they have was because obviously to go over the top of the appraisal, the conventional loans typically worked better. If on the VA and FHA loans, it was tougher to do. But here's what I want to show you. Over the past 5 years, this number, the VA loans in there, FHA, not a huge percentage, but VA loans over the last 5 years have ranged anywhere from 26 to 30% month to month, depending on where you're at. So if you think about it, in our current market, over the last 5 years, and really if you go back to the last 3 years is where some of the really, really, really low interest rates were at. During that time frame, almost a third of those loans were VA. So as you're prospecting out there, as you come across those loans, it's important to understand that you really have something that's sellable, because that rate is down there 2.5%, 3%. Okay. And so I wanted to show you the stat. About a third roughly of the loans that are during this time frame that we're talking that are going to be those loans that people want to assume are VA. So you definitely have a target market out there to go after. Some FHA, but VA is the predominant one. All right. Now, what I'm going to do, I just wanted to talk about that before we even went into assumptions. And before I even go on, are there general questions about assumptions I can answer before we even go on? Okay. If there's not, here we go. Okay. There's a company out there called Assumption Solutions that we're working with. And the whole purpose of Assumption Solutions is to be able to help you guys navigate the assumption process. The last time that there was this demand for assumptions was well over 20 years ago. And so the lenders have no idea what to do. In fact, that's what we're finding out right now when we deal with the servicing agents who are handling these loans. It's like starting all over. It's, you know, it's a brand new thing. It's a brand new process for them. So they don't know. So as we kick this off, I just wanted to let you know that, like, to navigate this process, the lenders are not set up to do it yet. And they really honestly don't know. So sometimes you just getting to the right people is the whole key. Okay. So on Substance Solutions, I just wanted to talk about that. Here's the types. What is a mortgage loan assumption? Literally what a mortgage loan assumption is when, as a buyer, instead of going and getting new financing, I am going to qualify with the old servicer. Okay. I'm going to qualify just like I did get new financing, but I'm qualifying to take over, excuse me, that loan that's already there. So I'm not getting a new deed of trust. I'm going to take that deed of trust that's already there. So where rates are 5.5% right now, I'm going to go get that 2.5% loan. I still got to qualify. And the one thing I want to say right up front with these guys, they take longer. We're anticipating 60 to 90 days anyway. But I wanted to just let you know that it is going to take longer. So factor that in for both buyers and sellers in your thinking. And the absolute truth of the matter is, at this point, we're not positive. I will tell you the ones we've done are around 60 days. But it's hard to tell. It's going to depend on the servicing agent that you get. In other words, the person that's actually handling that loan. That's how you're going to figure out how much time it's going to take. So it says, what types of loans are assumable? Typically, FHA and VA are the ones. VA in our market are going to be the more predominant ones, but there will be some FHA. So this also helps you guys go out and market for those types of loans in the market, for both as a listing agent and then also as a buyer's agent. If you're shopping for your buyer who in the current market cannot qualify because of interest rates, you can look in the MLS and find those assumables too. So I would encourage all of the listing agents representing the sellers, stick it in the MLS, okay? And all the buyer's agents start paying attention to that if you have a buyer that's not qualifying under current interest rates. So a mortgage loan assumption occurs when a willing home buyer takes over and becomes responsible for an existing loan. Again, keep in mind, it's not a new deed of trust. It's not a new promise. You're taking over a loan that's already there. That's what an assumption is. The two types are qualifying and non-qualifying. We, for those of us who've been around a long time, the non-qualifying were super good. You love those very much. Very few of those will be non-qualifying. So almost everything you're going to be doing is qualifying. The borrower's going to have to go. They're going to have to qualify to get the loan. Almost all assumable loans require that the buyer qualify to the same standard that the original borrower did was held during the original loan origination. What that means, guys, is whoever our buyer is that takes over that loan, they need to make sure that new buyer qualifies, because what's going to happen in assumption, if it's done correctly, the seller will be released from the liability of that loan, and that's critical for your seller. So that's why the new borrower has to qualify, and literally has to qualify to the same standards that our original borrower did. Okay. So it's not like they don't have to qualify. So if you have somebody who's just their credit's terrible and they've had a bankruptcy, an assumption's typically not going to work. Okay. But they still have to be good, but they don't have to be great as far as income goes, because again, you already showed you the difference between 5.5% and 3%. Okay. As far as being able to qualify. So almost any loans are assumable. The buyer must qualify to the same standards that the lender did. What types of loans are assumable? Almost all qualifying assumable are FHA or VA. VA loans can be assumed. Now, this is kind of interesting. VA loans can be assumed by veterans and non-veterans alike. Now, one caution, and I just want to bring this right up front. If you have a veteran or a non-veteran that's assuming a veteran's loan, a veteran has eligibility that they have that's tied to those loans. If it's a non-veteran that's coming in, typically they're not going to take over that eligibility. So technically, if that VA borrower wanted to go get another loan, their eligibility is going to be tied up. So I'm just throwing this out there. Typically, if you're working with a veteran who has a VA loan, from their standpoint, it's likely going to be better to find another veteran to assume that loan, which in our market is fairly easy to do. But the reason you want to do that, because you want to get their eligibility released as well as the liability on the loan. But I do want to let you know that that a non-veteran can assume a VA loan. Only assumption by another veteran will release the entitlement of the original borrower. So if you're representing that seller, it is better if it's a veteran to come so you can get their VA entitlement released. Okay. FHA loans can be assumed as long as the requirements are met below. And I want to let you know none of these are investors. You can't bring an investor in to assume these. These are 1 to 4 family residential loans. So it's not going to work with an investor. Okay. So I just wanted to let you guys know that for sure. All right. All right. So VA and FHA assumption process for sellers. So we're going to talk about, you found this seller, you've pulled your O&E, you see that it is a VA assumable loan. They have their original promissory note. You know exactly what their interest rate is, what the terms of that loan are. So now what you're going to do is you're going to confirm that. So you're going to take the loan amount, interest rate, and payment. You're going to pull your O&E. Please make sure you do that. Your owner's and encumbrance report. It's still going to be critical because that's not going to have the promissory note. Okay. So your seller will likely have a copy of that promissory note in with them. So you connect the seller to Assumption Solutions, have the seller sign. There'll be an engagement letter to do that. Then what we're going to do is the seller's going to upload the required documents into a portal. Okay. We'll be able to communicate with the servicer on the seller's behalf. If you do this yourself, and you can, you're going to have to get a letter of authorization from your seller if you're going to communicate on their behalf. I will tell you, most sellers will not be sophisticated enough to understand the process. And most buyers, as veterans, probably will not understand the process fully. The buyers, what they get is, hey, I can buy more house because that interest rate is lower. The sellers will get, my house is more valuable because of that lower interest rate. But as far as the details of having to work with the servicing agents, it's unlikely you're going to have buyers and sellers that really understand how to deal with the process itself. So what we're going to do is we're going to contact the servicer on the seller's behalf. And one of the cool things about VA loans that I like we still have a company called Short Sale Solutions that's there, and we've actually done a couple already this year. But the interesting fact about it is if it's a VA, if we're not getting response from these people, senators and congressmen will get involved because it's a veteran, because it's a VA loan. So one of the other things I like about this, if we're really not gaining traction, we have the ability to go to congressmen and senators to kind of loosen it up to get information flowing if we have to do that. So we execute an assumable purchase contract. Now, when you guys are going to write a contract, if you're a buyer's agent and you're going to write this up, again, I want to say allow more time than usual. We're guessing 60 days. The ones that we have closed have been about 60 days. But I'm telling you, I would tell people 60 to 90. And then the buyer and their agent with some solutions. So we'll put all the contract together. We'll start working with that servicing agent. The buyer's going to have to complete an engagement letter and upload. If you don't use Assumption Solutions, you're going to have to do this on your own. So you're going to have to get an engagement letter that's screened. The servicer assumption approval, the servicer will review the documents. What I'm talking about, the servicer, is that entity that's holding the existing loan. That's what the servicer is. Okay. So you have a servicing company that's holding that loan. That's who we're going to be dealing with to get the assumption done. And again, the tricky part right now is there's not a lot of these. There will be, but there's not a lot right now. So there's really not processes in place. I am guessing that over the next 6 months to a year, that you will have servicers that start to put like their own portals in place and stuff, where you can upload. Right now, it's just not that way. There's just not enough of them there. So the servicer is going to review all the documents and the qualification. The timeline is going to vary. Expect 30 to 60 days. The only reason we even put 30 in there is because I love real estate agents. You guys are the most optimistic people I've ever seen in my entire life. Like, I can tell you right now, there is a comet that's the size of the moon on the way that's going to smash into the earth. It's going to create an atomic explosion and then vaporize everything. And then it'll be encased in a frozen thing that's 3 miles across that. And I'll still have some of you guys saying, so we got a chance. Okay. So the only reason we threw 30 days in there was because I just know how you are. Okay. But anticipate 60, could be 90. Once approval, closing can take place. The seller success fee will be paid. And Assumption Solutions are going to be charging $475 per side. And the only way we're going to charge that is if the deal closes. If the deal doesn't close, there's no charge. Okay. Now we're going to go over from the buyer side. So let's say you're a buyer's agent. You've been working with them. You found a buyer who really can't buy that $500,000 home at current interest rates. You've gone in the MLS. You found a 3 or a 2.5% interest rate that's assumable. And so now you're working with the buyer. One other thing, guys, there could be a gap in this depending on where the home's bought at. So if we have, like, give an example, we have a veteran buyer that's buying a $500,000 home. Let's say the loan is $500 and your purchase price is $520. The veteran may bring in some money to cover that difference. So I just want to clarify, there could be some places, where the veteran may have to bring in some money on top of that loan that they're assuming to complete the purchase. Okay. So what you do is you search for the property, and this, again, as a buyer's agent, you search for a property that has an assumable mortgage. You're going to review the existing loan docs and confirm it is assumable. The buyer should review the loan balance, interest rate, and payment, so that we'll know what it is. So again, you're assuming a loan that's already in existence, so you know exactly what those payments are going to be. Okay, so your buyer needs to know that they can make those payments. They're going to have to qualify, obviously, but they'll know exactly what the payments are. The buyer should have a plan for covering the gap in the purchase. We did one that was it was a $1.8 or $1.9 million deal. It was an $800,000 VA loan. And we had two veterans who, the buyer on this case was really good. And he I wouldn't recommend doing it this way but this guy had spectacular credit. What he did is he actually ran a loan right by, just in case he couldn't get the assumption done. So he was running a loan and we got the assumption done. So he used the assumption. Okay. But in this case, that loan was only $800,000. So he brought in the difference. So just know that they may be bringing in the difference between the price, and basically that's an effective down payment. So have the buyer sign. And again, if you use us, you're going to have them sign a letter. If you're going to do it yourself, you're going to have them sign a letter. They're going to have to upload, like in us, we've got a portal that they're going to upload everything into. One of the things that we're going to do is pull a soft credit. Now, what we're going to do with that is, as a company, make a decision on whether, if you have somebody just had a bankruptcy, or you had somebody, that just came out of foreclosure, the chances of them getting that assumption is almost nothing. So one of the things with Assumption Solutions that we're going to do is pull a soft credit. It's not going to affect, it's a soft hit. It's not going to affect their credit score. But I'm saying, if you do that yourself, I wouldn't recommend it, but if you're going to try this on your own, you want to make sure that your buyer can really do it. And if they've had a bankruptcy or foreclosure or short sale recently, probably not going to work. Okay. Then continue the normal contract process. So we'll go ahead and do the title work and the inspections. Even though we're on a 60-day or a 90-day, go ahead and do your inspection, because what happens if there's something wrong with the house and you're not going to buy it? So I would run your dates, most of them, just like it's a 30-day close. Go in and do your inspection. We get the title work out. We take care of all that stuff to make sure. So then one of the last approval dates before closing the contract should be that loan transfer deadline. I really want you guys to pay attention to this. There's been a part of your contract that I guarantee you most of you have really never paid attention to, but it talks about the loan transfer, the loan documents, approval deadline. It's up in the front of your contract. I believe it's in the sections 2, if I remember. But it's a part that you guys hardly ever fill out. And then an assumption you're going to be filling that out. So it's the loan transfer deadline. It's the loan documents deadline. And it's one that's always been there. It's not new. But when you go to do one of these deals as a buyer's agent, you're going to need to deal with those dates. There's only 2 or 3 of them. There's a deadline of which the loan servicer to approve the transfer. So there are some dates in the front of the contract that, as a buyer's agent and as a selling agent, you're not used to seeing. So that's going to be kind of new in your process. The servicer assumption, the servicer is going to review all the documents for qualification. Okay. The timeline's going to vary. Again, I'm being optimistic at 30. I hope it works at 30, but I hope I lose 10 pounds tomorrow, but that ain't going to happen. So once approved, closing can take place. The buyer success fee is paid. Again, we do 475 aside for that. So I'm going to go on to the next page. Okay, pricing. This is the pricing that we're doing. We're doing 475 per side on this. If you choose to use us, in most cases, the cost, and there's typically the servicer will have a fee too. I'm seeing those anywhere from $750 to $1,800. So there's typically a fee that the servicer itself will charge to transfer that loan into the new buyer's name. Okay. Closing more deals. So what we want to do, the goal for you guys is to help you get a successful sale in a market that has interest rate changing. Successful are going to use all the tools that are available to you. Back in 2008, 9, 10, 11, and 12, I started a company called Short Sale Solutions. And that was to help you guys through the brutal process of dealing with people whose there was no equity, and they had to deal with the servicers to get the property sold, to sell it for less than what was owed. So in this case, they're not selling it for less than what's owed. We don't have that on, but we have a process that's hasn't been dealt with for literally 20 or 30 years. They do not know. And you'll have people when you call in at first will say, no, you can't assume it. Guarantee you're going to have that happen. And what happens is you just have to work your way up the chain to get to the people, and ultimately, if we don't, we'll get to congressmen. Okay. So what you're going to do is basically you're going to market to potential sellers with assumable mortgages. Again, the majority are going to be VA. So when you're out there prospecting, you look for those VA loans, and you're only looking at about the last 3 years where those rates were down around that. I've seen them as low as 2.1 on some VA stuff. There's a lot of 3 out there. Okay. Market to purchasers who may benefit. So as a listing agent, if you come across that deal that there is a 2.5%, 3%, put that in the MLS so the buyer's agents could see that. They may be working with the buyer. I talked to an agent just the other day that brought 3 people back into the market who thought they were done. With an average price that we see now of 500,000, rates at 5.5, it knocked a lot of people out. They brought 3 people back into this market who will be able to purchase because of the assumptions. Properly market your listings and show that, yes, it is an assumable mortgage. Now, again, you're going to have to educate yourself and talk to the sellers and explain to them what's going on. Listen, at 2.5%, you got an incredible interest rate that's going to be very valuable in today's market. Okay. It's going to be some brain damage, but it's going to make your property worth more out on the market. Okay. And so explain to them there will be a process that they go through. Ultimately, you want to get them relieved of the liability and also free up their eligibility, okay, for those veterans, okay? Leverage experts to help you. We're here to help you get through this process. Assumption Solutions can give you tools to help you guys make it through this. All right, market to potential sellers with assumable loans. So basically, even in your current databases, it doesn't hurt to go through and, check with your past clients and see if they have FHA or VA loans. One of the things I've always recommended that when you work with clients is know the types of loans and the interest rates that they're at. And the reason I've always said that, because if interest rates fluctuate, and it was time to refi, you could always call and maybe even set them up with a lender to do that. Because in my mind, as a real estate agent, you guys should be the expert of all of it. If they think about real estate, they should be calling you to answer any real estate questions. So look through your past clients to see if they do have FHA or VA loans. Leverage your social media to educate homeowners. Okay. Get out there, tell them about the assumption, tell them what it is to do the process. Utilize farming tools to search for VA. You can call and we can give you lists that show VA loans. You can buy farm lists of those to go out there and prospect those types of loans. Teach classes to your homeowners that having a low interest rate in today's market could be something that makes that home definitely more sellable. Okay. Integrate the listing presentation flyer. Throw the Assumption Solutions thing in there when you're sending that out. You don't have to recreate the wheel. Okay. So definitely take advantage of all that. In every market, there's opportunity. I've always said that. Back in 8, 9, 10, 11, and 12, we did Short Sale Solutions. I literally lost 3 people who had health problems that worked for them because the short sales were so brutal. I'm not anticipating these to be quite as bad, but you're still going to have a lot of bureaucracy that you're trying to deal with. Market to potential purchasers who may benefit. So again, same thing. If you've got buyers in your database right now that all of a sudden they thought dropped out of the market because the rates went up to 6%, it's like I can only qualify for a $300,000 house. Okay, I'm not going to do a show of hands, but a $300,000 house is not much in today's market. Okay, so this could get them back into that 500, that 450. Okay, so again, check with your past clients on those buyers to see if they could benefit from it. Again, use your social media to educate and to help your buyers. Your buyers may think, hey, I'm out of the market. I can't because the rates have gone up. Educate them and let them know, no, there's assumptions out there. Let's take a look at those. Connect with the community of veterans and show them how assuming a loan and swapping their entitlement. One of the things that we've already found out, when you're working with veterans who are doing an assumption, the eligibility piece of it actually doesn't happen and verified until after closing. And both veterans have to be involved in it. So one of the things when you're educating people on the assumptions is going to be, seller veteran, buyer veteran, we're going to go through this. For seller, we're going to get you release of liability on the loan, but you also have your eligibility. For that buyer, you got to make sure that buyer veteran does have the eligibility. Let's make sure theirs isn't tied up somewhere else. So those are all conversations that need to happen, because the one thing we don't want to do is turn this into a circus. You want to make sure that you're doing good for both parties. All right. And if you're representing that seller veteran, make sure that they're released from liability of the loan. Make sure that their eligibility is released. For that buyer veteran, make sure they have eligibility, that theirs isn't already tied up. Because if you're going to represent them as a buyer and they go into the transaction, you want to give them the best leverage that they can to be able to purchase that home. And in our market today, you got to make sure that they have their VA eligibility. Okay. Again, you can teach classes for your buyers and show them that there are opportunities, even though interest rates have gone up. Do the buyer presentation flyer, send it out. Again, you can use the one we got or take ideas from it to be able to go out and educate your buyers. Properly marketed listings that are assumable mortgage to all purchasers. Here's something that I'm starting to see even in the MLS. I am starting to see stuff show up in there says, yeah, I do have an assumable loan. So most of those MLS systems has fields dedicated to existing mortgages that are already in place. So go take a look at that. Be certain to get monthly payment into the remarks. So, if you're representing that seller, what those payments are. And so you could actually put those into the remarks, out there for prospective buyers and buyers agents who are looking for those things. Because again, we know what those payments are going to be. Okay. Use your social media like crazy on this, blast it out there, highlight the assumable mortgage asset and payment savings at open houses. So if you're going to do a house and you've talked to a veteran and he says, yes, I'm open to letting my loan be assumed, that's something that you want to advertise in your flyers out to the public. Again, that will bring you more prospective buyers. Market that the savings. One of the things that we can even help you with is show the savings where rates are at right now versus what that assumption payment is, and show them the difference in those savings. Again, these loans are over the last 3 or 4 years. So there's still probably going to be 26, 25 years left on these loans. So think about that. If you're saving $700 a month, $800 a month over the next 25 years, that is a huge amount of savings to your buyer. And those are things that you need to emphasize to them to show them how much they could save doing it. Show buyers and their agents that you have a team that can help you do this process. Okay. So the big thing for the agents out there today, number one, bring yourself up to date on these and understand them. Number two, understand the effective marketing that you can do on these, that low interest rate loan is definitely good for it makes the seller's home more valuable, and it brings buyers into this market that may have gotten knocked out because of interest rates. Explain to them that, yeah, you're going to take over that new loan. You're still going to have to qualify. So for a buyer, the process is not easier. So please don't go out and say that, this is just a piece of cake. It's not. It's going to take longer. And lenders right now are not staffed up to do this. So you're going to be dealing with a servicer that's in Dubuque, Iowa, and I don't have anything against Dubuque, Iowa. I'm just making that up. But basically, there's going to be one person that's sitting there, and because of COVID, their cat and dog will be right next to them, and they're going to be processing and going through stuff. And when their favorite TV show comes, there's no way they can continue to process when they're doing that. So this is just going to take longer to get done. Understand that. Prep your buyers and sellers. Listen, there's going to be a little bit of pain with life. It's not all roses. Well, for me, it is. I'm married to Rhonda. How else could it be better? But the bottom line is it's going to be a little more challenging than a regular deal. But what your buyers are going to save over the lifetime of that loan is huge. Okay. Having a seller that has an asset in this market that makes it more sellable is huge. We all know the market's cooling off. You notice I didn't say crash. I get people say, Bill's going to crash. I don't believe that. Over the last 5 years, way more than 50% of the loans have been conventional loans. Okay. We've closed deals with people who have not made payments for 2 years and take money from the closing. Okay. So I don't believe there's a crash. I do believe there is a correction, and we're going to go back to what's normal. Okay. The one thing that's different in this market that I don't think most people have ever seen is there will be assumptions in this market because of what interest rates have done. When we hit those rock bottom lows, they are going to be very valuable for both the seller and the buyer. Okay. All right. So leverage the experts to process this. So our goal is just to help you through this process. Anything that we can do, please let us know. If you have general questions, let us know. If you're going to try your own, I'll help you. Give me a shout. We'll see what we've done. We're already doing these in here, and we're doing it. These started without. This has really been created out of the same thing that started Short Sale Solutions. I don't know if you guys remember, but people was trying to do their own short sales, and then you guys started committing suicide out there and getting out of the business. So we don't want that to happen. So the bottom line is we're trying to help you navigate something that's new, that most of us, I only have a couple closers here that honestly feel comfortable when we first start doing these with the settlement statements, because it's weird because we all have this concept, well, it's a new loan, we got to do this. No, because remember, we still got escrows, right? So the seller still has insurance and property tax escrows sitting with that lender, and different servicers handle those different ways. Sometimes they just refund them all to the seller and then recollect everything from the buyer. So so servicers are going to handle those differently. So it's going to look even different on your settlement statements than what you're used to seeing on what they're going to do. And we kind of have to follow their direction, on what they're going to do. Again, different servicers are definitely going to handle it differently. Okay. And hold on one second. Okay. I just wanted to show that there's me on vacation. I can't go on vacation even without marine animals picking up on my wife. It's just hell. Okay. So anyway, I had to get out of that. Had to do that. Sorry, Ronnie. I know she's watching. She probably won't watch ever again after this. Okay. Now we're going to go to, I also have some documents that I wanted to share with you. Let me find them. Okay, you should be seeing right now, these are some VA docs that we have that are going to be in there. And so this is some of the documentation that the servicers typically are going to require. Okay. So it even shows the stacking order of documents. And then the application for assumption approval and release from personal liability to the government on that home loan. So these are some of the documents you're actually going to be seeing. The statement of a purchaser on owner of assuming the seller's loan. Basically, it says, please read, make sure you're understanding what you're doing. And then the statement of veteran assuming a GI loan. So this is all paperwork that we're going to have that's outside the norm. That's stuff that we typically would not see, but you're going to see in an assumption. Okay. So without further ado, I am going to open it up and see what kind of questions everyone has.
Hi, Bill. This is Debbie.
Yes.
It's a two-part question.
Okay.
You had mentioned that the buyer needs to bring the difference between the loan balance and the purchase price. Now, is it the loan balance due, or is it the principal amount of what the original loan amount?
It would only be the difference of what the loan is, what's the balance that's out there,
Okay.
versus what the purchase price is.
Okay. And then when the VA has to show their eligibility, does that include up to the total loan amount of the original loan?
Yes.
Okay.
And you know, when we said in there that they have to actually meet the qualifications that original borrower did.
Yes.
So yeah, so they're not going to go, okay, we've paid it down. I'm just going to use an example. This loan's been out there for 5 years. It was a $500,000 loan. We've paid it down, principal $490,000. I'm just throw that out. No, you're still going to have to qualify for the 5 and not the 490.
Thank you.
You bet.
Bill, it's Stephanie. I'm jumping in here. I wanted to let you know we have a handful of questions in the chat box if you'd like to go through that real quick.
Perfect. Let me hit her. Okay. Oh, cool. Well, I'm just going to start at the top. Juanita, thank you, by the way, for coming in. It says, do you know?
Do you mind taking up your screen share as well?
Oh, perfect. Yeah. Hang on just a second. Good idea. Crazy kids. Okay, I'm stop sharing. And let me do this. Stephanie, I may need you in here to do this one. I'm not sure I can do. Can I do that with that? I got it right there.
You're good.
Hold on. Right. Will that show on there though? Like I got it on share and I'm just trying to share it. Oh, gotcha. Okay. Gotcha. So here's what I'm doing. Could you guys, I'm just going to go from the chat box. Sorry, I can't pull that on. I'm probably technically inept if you really want to get down to it. But I'm going to start. Juanita said, and if you guys look at the chat box, do you know if qualifying assumption will be similar to qualifying for a typical loan? It will be, but probably a little more. You're not going to have that loan originator that you would typically have in a new loan. We'll have a person that will work and help go through that process. I would say it's going to be a little more cumbersome if you really get down to it. It's going to be just a little more cumbersome than what a normal thing would be. The next one is Jennifer. It says, it's an easy way to make a quick discovery on whether or not the lender or servicer of a loan will allow the assumption. That is a great question. Here's what I got to do tell you on that. There's really not, we're going to have to call that servicer. And we've already ran into this. You have people, let's say you just get hold of somebody in that servicing agent who they may even tell you, no, the loan's not assumable. I have a rule in short sales and assumptions, never believe anything the lenders tell you. If we have to, we can absolutely get up to a congressman or senator because they set these up to be qualifying assumptions, and they are. And so if we have to, we'll get senators or congressmen involved in it. Kim, let's go on down. What about the difference from what the loan balance and a purchase? Okay, I think we already talked about that. what's the difference between what their loan balance is and the purchase price. Again, you'll go the difference between what's due and what your purchase price is. In most of these, they're probably going to be bringing in some money. So that's another thing you got to prep, your buyers for. If we have a balance out there of 575,000 and the purchase price is 600, that's 25,000 that the buyer is going to be bringing in. Let's see here. Let's see. Does it work for both primary home? No. So great question, Tracy. It does not work for investment properties. These are only single family 1 to 4 primary residence purchases. So you're not going to be able to use these for investors. There's something being shown on the screen. Let's see here. Can a pre-foreclosure be assumable? Okay, now I'm going to clarify that one. So just to make sure, if you mean by pre-foreclosure, the notice of election and demand has already been filed. So in Colorado, the sale will have to be between 110 and 125 days. The answer to that is maybe, because you're going to have to get another contract in to get the servicer to postpone the sale. It's likely that if you have a legitimate contract that yes, we can, but I'll tell you, if you take this listing and there's only like 3 or 4 weeks before the sale, probably not going to work, because typically lenders who are in foreclosure in today's world, they're going to want 2 to 4 weeks for, to look that contract over to postpone the sale. So I would say if you're seeing somebody that's weeks away from the sale, probably not going to work. If you found somebody that just went into foreclosure, the sale's 110 to 125 days, likely if we can get a contract in, we can get that sale stopped. So the answer would be yes, they would likely postpone the sale for us to be able to do the assumption. Okay. Can a seller carry back in second, closing the gap? I'm going to have to defer on that one. Typically, they don't like secondary financing. Let's see here. I'm going to have to get to you guys on that. Can they do like a second? I would say typically not, because on VA loans, they don't want secondary financing in there, but I don't know for sure if they would allow that. So in other words, instead of bringing in the difference, you get a loan that goes into a second position. That one, I don't know. And I will check on that and let me know. So and let you guys know. My guess is no. The next question, are servicers required to participate as if benefits their veterans, or can they refuse? Typically, if they don't participate, we're going to get the congressmen and senators involved to motivate them to participate. If qualified veterans purchasers are assumables, does this free up all the selling vets eligibility? So if you have a qualified veteran who is purchasing, yes, the goal is to take our seller's eligibility and replace it with the new buyer's eligibility. So the answer to that is our goal to do that, is to make sure that their eligibility is freed up. What's the average amount of time a servicer to report eligibility, transfer, and release? I don't have Brian sent that one in. Brian, we don't know yet. The ones that we've been doing, both veterans have been in contact with the VA. And so I don't have a time frame on like exactly how long that's going to be, before that eligibility is for sure released and the new one's put on. I do know that it's not done prior to closing, because we've ran into that. And I do know that both veterans will need to comply to work on that to make sure that that piece does get done. Okay, could a second or her cover the gap? Okay, and again, we're on seconds. I'll do some checking into the seconds. My gut feeling is they probably will not allow secondary financing, but I'm going to do a check, and we'll have a list. We got a list of everybody that's on here, so I will do some checking to see. My gut feeling is no, I don't think they will allow secondary financing. What happens to the VA loan? Another question came in, and it has to do with the gap. Karen sent that in. What happens if the VA loan, 580 balance, and the house is worth 550? Is it worth it for the buyer to overpay to pay 30,000 out of pocket? Will the VA allow that? Typically, yes, they're going to allow you to bring cash in. That's not going to be a problem. It's the secondary financing that I'm going to have to do some checking. Who generally pays the service fee? Is it something we need to put into the contract? For us, yes, it would be a service fee for the one for the buyer, one for the seller. It'll be on the settlement statement. At the closing table. And so, yeah, it would be, if we're going to be a third party vendor. So what's going to happen is it would be a check to Assumption Solutions from the seller and the buyer, put on the settlement statement. If you want to alleviate that there's going to be any confusion, write it into the contract. The other thing that you might put in there too is typically there's also a charge from the servicer. Remember, probably somewhere from $750 to $1,800, somewhere's in there, that the servicer is going to charge in addition to that. Still well below what you would get on, like, if you were getting brand new financing, you're still going to be well below what that's going to be. Okay, sounds like okay. Amy Jones, yeah, and a case by case on these, on the variances, it is, especially for now. There's not specific processes for these yet, and so it really is going to be case by case. We're just delving into this right now. Bernie, what do we recommend on those contracts? So right now, if you were going to do the contracts and writing those in, I would I like the things that you want to happen. It doesn't hurt to put that in the contract. Anything like, we have a veteran buyer, we have a veteran seller. The intent of the contract is to have the seller veteran released and to have the eligibility released and taken over by the new buyer. So those are things that, yes, you absolutely could put in. You'll definitely want to put in there that it's an assumption, and that could go to additional provisions. But remember, you're also going to have those check boxes, on the contract that we don't normally see, that talks about transfer of the loan and talks about the buyer's credit information. Again, when you don't hear in a minute, I'll grab a contract and tell you exactly what they are. Let's see, Tiffany, is a better place. Okay, it's better.
I'll explain that one. Is it
Okay.
better to actually, when you put the home under contract in the
Okay.
MLS,
All right.
is it smarter to put it like under contract pending, or is it smarter to put it as a first right of refusal? Just because this process sounds so long, could you literally get into this process and be 60 days in and find out this isn't going to work?
You could find out something in the buyers, on the buyer side. And I'll just give you an example. Like we see in regular deals, the buyer goes and buys a car and takes on additional debt. I mean, that's something that could literally kill it. I got to think through that one as far as if you put up, first, because typically you can always take a backup, no problem. That's there. And if the deal falls, you can. This on that first right of refusal, typically that comes when like an HOA, has the right to purchase a property when an offer comes in. So
I think, some of us have a tendency to use that if we're doing a contingent offer. If we've accepted a contingency or something, and we like to leave it on the market if the other house doesn't go. So that was sort of my thought process on it.
Gotcha.
Just wondering how long, with, like I said, if you're 60 days in and you find there's a problem with the eligibility or something, you've kind of screwed your seller on that one.
Yeah. You know what? Absolutely. I don't have a great answer on that one. We could probably have input from others. That I really don't. I'm not, I get where you're coming from. I truly do. Because this could sit out there. And again, you could have your buyer do something that's silly and kill it. And so, interesting. It definitely doesn't hurt. And if both buyers and sellers, agree to that, you remember our short sale addendum that we have, you could make it similar to that. And by the way, I'm not an attorney. I did stay at a Holiday Inn Express last night. But the bottom line is, it's whatever buyers and sellers agree to. I mean, if you wanted to write something in there that if this, if it goes 60 days and blah, 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 you could put language in there just as long as buyers and sellers agree to it. Okay. Let's see right now. Carrie, I love it. On those USDA loans for the first time home buyers, they are under FHA. I cannot answer that one. I would say they're assumable, but Stephanie, please jot that one down too. I do not know for sure. So one, the secondary financing, and I'm talking to my Stephanie, and then two, let's check into those, see if those are, I don't know on that one. How does a non-veteran assume a VA loan? Okay. The non-veteran can do it. They go through the process. They'll fill out the 1003, the loan app. We'll send that to the servicing agent. The downside to the seller is obviously they're eligible. They may get released from the loan, but their eligibility may not be released. So you can have a non-veteran assume it and take the liability off of the veteran, but it may not release their eligibility. So that's the danger to having a non-veteran do it. You know, you may have a veteran. Let's say you have a veteran that's that for some reason doesn't really care about their eligibility. I don't know why, but let's say they really don't. There would be a case where you could look toward non-veterans to come in and assume, because it still takes the liability, because remember that non-vet still has to qualify and everything. So it will release them from having to do the loan, but it will not release their eligibility. Okay. Let's see. Given there's no new loan due appraisals come into play on the assumption. Given there's new loan due appraisals come into play, I don't think so. Your buyer may still want to do that, but typically there's not a new appraisal required from the lender because they already got it. You know, they had an appraisal when they issued that first loan. You know, a buyer may want to, you know, depending on where that price is, but from the lender side, they had an appraisal when they originally did that loan, and so typically they're not going to require a new appraisal. Let me see. Let's see, Kim. Let's see, does $1,800 fee get added to the loan or paid out of pocket? Typically, that $1,800 fee is paid by the buyer. Okay, or that could even go to the seller. Okay. I assume the VA back in the 80s, and it tied up their eligibility for 15 years. They, of course, were not happy. And then Kim also wrote this. She assumed a VA back in the 80s and tied their eligibility up. One of the things that's going to be critical for this process is to work with the veterans to make sure that eligibility does get released. The tricky part's going to be is it's not released till after we closed. So there's where it becomes a little more tricky to do it. But yeah, Kim, our goal is to get that eligibility released soon after the closing happens, not be tied up for the length of the loan. Okay, since most sellers are equity rich when this is going to fall in, Amy, and I got to tell you this, it's, even though it's a seller carryback, that's still secondary financing. I got to check into that. I know it's not going to be a problem if the new veteran brings in cash, but the secondary financing piece of it, I got to check that out. Let's see, Amy, can you pay? Tom, okay. Can you pay the veteran additional legal? Oh, can a veteran additionally?
For that one, Bill, I'm just asking, like, if a non-vet's assuming the loan, can you give the vet who's giving up their entitlement something legally? Like, can you pay greater on the purchase price? Because there's a benefit to that, but I don't know what the legal ramifications would be.
And I don't know that one. I don't know. And so you're saying pay the veteran for their eligibility because they're not giving it up? Is that what?
Right.
Okay.
Right.
What I would say, if there's really that gap that you're going to bring, I don't know that I would bring it up as we're paying him for the non-release of that liability. It would be the gap because the property's, you know, worth $550 and the loan's at $450. So you're bringing in that $50,000 spread. I probably would not go into, we're paying him extra because of that eligibility not being released. I can't answer that one. I would be afraid to even get into that. If you just go into like, okay, you know, here's where the market's at, here's where this loan's at, there's a spread, I don't think you're going to have any problems there. But if you start dealing with, well, we're going to pay him a little bit extra because I don't know the answer to that. That one's a complicated one. Personally, like, my gut feeling is I'd want to be careful.
Okay.
I try to stay away from that. That's a great question. Okay. And then Timothy. Okay. And it says, if we have a home that the seller's interested in looking into this, our first step is to reach out to you guys and start the process. You will then help us determine. Yes. And that's absolutely right. So you have a seller that's interested in doing this. When we're still working on getting our engagement letters out, we'll have those any day now. But yes, the bottom line is we'll do an authorization with that seller to be able to contact the servicing agent immediately. So we can start that process going, before we even get a contract on it. So yeah, if you have a seller that's interested, we'll have an engagement letter for them right up front, and we can start working to get to the servicers to figure out exactly what we have.
So I do have one of those, Bill. That's
Okay.
it worked out really well that this class was at the same time. So is that to you? Jamie Mears is my normal agent over there.
Okay.
Do I reach out to her? Do I reach out to you? Who exactly?
Yeah,
should we be?
just reach out to Jamie and the title company. I see our reps are all on here too. Yeah. So Assumption Solutions, you can reach out to your reps. You can reach out to Jamie, and then just make contact. And then what we'll do, we'll actually have a portal that they can go, and once we do the agreement, we'll have a portal that they can actually go and upload stuff into as well. And then we'll, from that, contact the servicing agent and see where we're at and go from there. So our contact with the sellers will be immediate. When you get that listing, and even with a buyer, if you have a buyer you think might be, I would go ahead and get them to us too, because remember, we're going to run that soft credit. And if something shows up in there, and I'm gonna give a little caveat here. If we, Assumption Solutions is a separate entity by itself, and it's an independent company and reserves the right to work with whoever they want and whoever they don't. If we see that person on that soft credit hit just went through bankruptcy, just had a foreclosure, we're probably going to say, and we got to be careful in that we give information out, but we can definitely make that decision and tell you, it's like, at this time, we're not prepared to work with that particular buyer. I don't know that we're going to share with you why. But we will come back and say, at this time, we're going to choose not to work with that buyer, because in our estimation, it doesn't appear that they would be a good candidate for that. Excellent. Lots of great questions, guys. And yeah, talk to Jamie. Absolutely. Does Jamie badmouth me when you talk to her?
All the time. No.
I knew it.
Not even close.
I absolutely knew it. As soon as this is over, I'm walking across the hall. I'm slapping her with my Barracuda. Okay. Do we have anything else? Thank you guys very much for being a part of this. I hope that you got a ton out of it. If we can help you, please let us know. We're going to try to make this thing roll. Again, in every market, there's opportunity, and we want to give you guys the tool. Our motto here is, we don't succeed unless you do. And we truly live by that. So if we can help you out, please let us know. We appreciate your time. I know you're all busy. It's 10:03. You've had more of me than you could possibly stand. I know you're going to try to get this time back in your life as soon as you leave here. So thank you guys so much. We appreciate you. Thank you for the business. And if nothing else, you guys have it's hump day, isn't it? Have a great hump day.